Gudani, can you hear me?
Yes, sir, I can hear you.
Okay, that's good. I'm just testing the signal. I'm in a new home and different Wi-Fi. Just want to check that it's all working. We're just going to wait for others to also come. It's 4 minutes to 2 now, okay?
Biloko. Sana sezo tamai. Ntichen. Ndo yen. Dora
Yeah, so good afternoon, guys. Hope you're all well. For today, just want to go through the tests and to just review what we've done and answer any questions you guys specifically have on the test or any other content. It's fine. I'm going to do maybe 2 sessions a week another few tutorials. We are fortunate in a way that we lost in the queue. So we're going to be writing exams third week March, somewhere there. And so it gives us a lot of time. There's no more tests coming. I'm busy marking it now. I want it to be finished by tomorrow, but I don't think I will be. Maybe next week. So it's quite a lot, and it's not easy to market, especially you know, if it's online. It can take quite a while. So just be patient with me. I've done the assignment marks. I don't know if you guys have seen it on the system yet. The assignments were done quite okay. Some better, some less good. The better ones you would have seen would have been graded in the region of 80%, and then the ones I thought could have been better were graded maybe in the region of about 70%. So I was very consistent in terms of how I graded it. So I think you guys should be okay with it. The main thing with the assignment is that we, when we look at the financial statements, the ones I graded a little lower, you guys didn't give me enough or any explanation in terms of the numbers that you gave me. So I wanted to see that you guys were able to interpret it, and this is important. I'll tell you at a later date why. Okay, so where shall we start? You can see on my. Can you guys see my screen? Can somebody just say yes or no?
Yes, sir. We can see your screen.
Yes, sir.
Ah, fantastic. That's good. That's a start. Okay, so this is the first test we did, and this one I think you guys found a bit easier, correct? Compared to the other ones, I think it was a lot easier. It was basically just to get you guys in the groove. So there's not much here, but I still want to go through it, go through the answers. You know, just to be sure that we're all happy. Okay, so in the first one, it's a theoretical question. It deals with the introduction of financial management or corporate finance, and this is kind of typical questions that you can expect maybe in the exam or similar, or you know, there's maybe some others as well. So it's important to not only cram these, it's important to understand them, because you must remember, you guys, in less than 6 months, you're going to be doing 3642. 3642 is like 2642, but just a lot more in depth. Okay, so if you don't understand these things, you're going to get lost somewhere along the line. So use this as a basis to get yourself prepared for the third year module. Okay, so it's the same, but a lot more. Okay, so in question one, it asks us to distinguish between capital markets and money markets, and give examples of each. Okay, so with the money markets, we know it's for the short-term funding. Now, short-term funding is what we use for you know, to buy inventory and things that we do on a daily basis, weekly basis. It's mainly deals with your working capital management, and with capital markets is where we need money for capital investments and any large purchases that we're going to be requiring. Okay, so for a money market, there's there's a short-term loan, a bank overdraft, and some others as well. You can have recurring credit and so on, and it's typically we get that from the banks. Okay, and then with the capital market, as I said, this is for the long-term finance. This is when you get shareholders and they buy shares, they give you money and you give them shares, or that's if you invest in equity. But if you invest in debt, or invest using debt, then we're going to have loans or mortgage bonds or debentures and etc. Okay, so the one is short term, the money market, and the one is capital market. There's a maximum of 6 marks. As you can see, there are more than 6 marks available, and then there's 6 marks allocated. Okay, so for the online test, this wasn't so difficult, but obviously when you sit in the exam and you get the type of a question like this, you're going to have to actually remember it very well. Okay, so indicate why agency problems exist between management and shareholders of the company, and also discuss 2 means by which shareholders attempt to align their objectives with their shareholders. Okay, so if we have management in the company, they have their own interest, okay, and it might not be the same interest as the guy that's got shares in the company. Okay, so the one is looking at making a quick profit, okay, and the other one will be looking at growing the value of his or her share within the company. Okay, so there becomes a conflicting problem. So it's an agency problem. Okay, so the management, they own a very small portion of the equity of a company. Okay, that's in most cases. However, that's also one of the solutions that they propose, is that the management of the company are able to buy shares. So if you're a manager and you also own shares, you're going to try and balance the interest of making a profit as putting your management hat on, and also the other one, you growing the value of your company. Okay, so the management are agents of the shareholders and should take actions to maximize the wealth of the shareholders. Okay, but there's a conflict of interest because they want to make sure that they get as much money as possible, and perks which could be at the expense of the shareholders. Okay, management have a greater preference for expenses that result in direct or indirect benefits for themselves. Okay, so they could make sure that they get a very high salary, have a nice office, travel a lot, and all these things that, it is in their own interest, but not necessarily in the shareholder. Okay, so management will be wanting to take more risks, okay, and where shareholders will make sure that risk is generally minimized, so they diverse their portfolio, and management will also try and grow the size of the organization and undertake unnecessary diversification to ensure continuation of their position. Okay, so how do we align these 2 parties so that they, look out for each other? Okay, so the threat of any takeover will ensure that management will act to maximize the share price, okay, and therefore make any potential takeover much more expensive and reduce the willingness of shareholders to accept any offer. The management of poor performing companies are often replaced in a takeover. Okay, so you want to get rid of those guys because they, in the first place, they don't want to. They don't want that to happen because it could not be in the best interest. Okay, then we spoke about the share options. So you give management the option to be able to buy shares. Okay, and then the shareholders can appoint a board of directors that may change the management team if performance is inadequate. Okay, so the manager must be held accountable. The market for manager may mean that move up to CEO ladder, management will have to show excellent performance. Okay, so if you don't perform, you don't move up. Okay, and the growth of institutional investors. Okay, so which they are always ready to act to replace poor management. So the management should be put on notice and told that he or she needs to act in the best interest of the organization. Okay, so that was 8 marks. This is very comprehensive. That's in this memorandum. But the more you write, the better, and the more you can score some marks. You can see 8 marks allocated as a maximum. Okay, so the next question. Explain the following concepts in the context of corporate finance. So it's portfolio theory, efficient market hypothesis, and the capital asset pricing model. Okay, so for the portfolio theory, it's a theory that stands on the premise that diversification of a portfolio will reduce the overall risk of an investment. Okay, and it's because numerous investments will incur losses as opposed to just or it's unlikely that numerous investments will incur losses as opposed to just a single investment. Okay, so you don't put all your eggs in one basket. You try and put it in different baskets. So if something happens to one bad basket, you'll be covered because you've got other investments as well. Okay, so in this case, I've actually given 3 marks. You can see here I've noted it's 2, but I've actually given it 3. It's 1.5 plus 1.5. Okay, so it's a maximum of 3 marks. And then efficient market hypothesis. You can see there's a lot that is written there. It's a maximum of 5 marks. The efficient market hypothesis theory postulates an hypothesis that a share price rationally reflect available information about the share. Okay, so it says that if you look at the share price, it can tell you a lot about this company. Okay, there are 3 forms of EMH, which is efficient market hypothesis, to determine market efficiency and pricing methods. So there's a weak, a semi-strong, and a strong form. So if you answer this type of question, always distinguish between these 3 types. And in the weak form, the share price incorporates all historic pricing information. In the semi-strong form, efficiency implies that the price incorporates all historic information and all publicly available information. And in the strong form, implies that the price incorporates all historic information, all public and all private information. Okay, so weak is all historic, semi-strong, historic plus public, and strong is historic, public plus private. Okay. So the implication of this theory is closely related to that of the cost of capital. According to the theory, if prices accurately affects the market valuation of the securities, and there's nothing management can do to influence the price of that company's own owns and shares, and thus it is cost of capital. So there's a relationship there. Okay, so that's all for a maximum of 5 marks. So typically you have to say what it is, which is in here. Then you distinguish between the 3 forms, weak, semi-strong, and strong form. And then you just tell me a little bit in terms of what it is. And then you can also mention the cost of capital as well. Okay, maximum 5 marks. So that is that. Okay, then the last one in question 1 is the capital asset pricing module for 3 marks. Now, if we go to the capital asset pricing module, it's a theory which assumes that financial assets in equilibrium will be priced to produce rates of return which compensates investors for systematic risk, as measured by the covariance of the asset's return with the market portfolio return. In other words, we're referring to beta. And this model in theory attempts to measure the risk of a financial asset and express the price in terms of the required return. And the model holds that a certain level of risk applies in a market to all capital assets and must be borne by the investor, while other risk is peculiar to the specific asset and can be eliminated through diversification. Okay, so that's 3 marks, and we will look at the practical application of this a little later now. Okay, are there any questions on this so far? Can I continue? Okay, I'll take that as a yes. Then in question 2, we're looking at time value of money and also again overview of corporate finance, some aspects there. In part A, we had some multiple choice questions, which mainly deals with time value of money. So the first one, Mr. Shavani wants to earn 5 million rand, okay, when he retires in 20 years' time. Okay, and if he can earn a 5% annual return compounded annually on his investment, the lump sum amount he would need to invest today to reach his goal is closest to what? Okay, so the information given, let's see what they've given to us today. Okay, so they've given us 5 million rand in future. Okay, so that 5 million rand, it's a future value. That's what you want in future. And then it's 20 years, it's compounded annually, so it's 20 periods. It's 5% per annum. Okay, so we need to invest today, which is the present value. Okay, so if we go to we can see in table 1A, which is the present value for a single amount. Okay, so it's very simple. Okay, this is now using the tables. We take the future value. Okay, maybe I should just open the tables. Just give me a second. Let me just open this one. Maybe I should just do that. Okay, so you can see there are 6 tables. Okay, so there's a present value for a single amount. Then the next one is a future value for a single amount. Then we've got present value for ordinary annuity, the normal one that you pay at the end of the period, future value for ordinary annuity, and then present value for annuity due, and present value, future value for annuity due. Okay, so there are always 6. These 6 tables you will always have. Okay, so what we're dealing with now, we're dealing now with one amount. There's no recurring amount. We just want to take one amount, put it in a bank, earn some interest, and you have some money at the end of the day. Okay, so that will grow. So in this case, let's say we've got 5 million, we've got 20. So because we're looking at one amount and we want to get the present value, if we go to this, we're looking at the time. You see there's n. Okay, so there's n, that's 20 years. Let's just make it a bit bigger. And we're looking at 5%. It's 0.377. So it's 5% and 20 years. Okay, so there's your 5 million times 0.377. It gives you 1.885 million rand. Okay, so which one is it closest to? It's quite obviously B. Okay, 2 marks. Okay, you have received an inheritance of 500,000 rand. Okay, so that money is here. It's here today. And you plan to put the entire amount in account earnings 10% compounded annually. Okay, and to withdraw 81,500 at the end of each year. Okay, so now we're not looking at one amount, we're actually looking at an annuity. It's an annuity that will pay you 81,500 rand. So for how many years approximately can you continue to make the withdrawals? In other words, you have 500,000 rand today. At what point in future will it be 0? Okay, so what we do is, if we use the calculator, you can say the present value today is 500,000. Okay, the interest rate is 10. Okay, the payment is 81,500 and the future value is 0. So the only one that is remaining is n. That's a number of periods. So the question is, what is n's value? They've given you PV, I, PMT, and EVI, and FV, and they're asking you, what is N? So the answer is A. It is 10 years. Okay. The main thing is to always see what have they given you, okay, and what is still left. Okay, NI, PV, PMT, FV. Okay, so there'll always be one that's left. Okay, then you can see, okay, this is what I need to calculate. Okay, Bakuzi Limited took out a 480,000 Rand loan. The loan is due at the end of 6 years. Okay, so you've got 480,000 Rand today. The loan is due at the end of 6 years, and the repayment amount is 779,648. What is the interest rate that Bakuzi is charged or is closest to? Okay, so the 779,648 is a future value. Okay, so if it's a future value, you need to divide it by what the present value, and then it gives you a factor. Okay, which works out to 8.42%. That's if you use the formula. If you use the table, you get this factor 1.624. If you use it by interpolation, you also get to 8.41%. So you can decide which way you want to go to if you don't have a calculator. Not all of you use calculators. Okay, so if you use a calculator, it's simple. It's a future value, 779, present value is 480, N is 6, and it gives you the interest rate of I, which is 8.4%. Okay, so always see what you've been given and see what is still remaining. Which of the following statements about compounding and interest rates would be the least accurate? The present value and discount rates move in opposite directions. In other words, if the discount rate goes up, the present value goes down. Okay, all else equals, the longer the term of the loan, the lower will be the total interest you pay. On monthly compounded investments, the effective annual interest rates would exceed the annual nominal rate. Okay, and the present and future value for period 0 is equal. Okay, so quite obviously B is incorrect because interest paid will always be longer over a longer period. A is correct because the more interest, the higher the discount rate, the lower the value is today. C is correct because the more periods you've got, the higher the effective interest rate will be. And the present future value for period 0 is obviously 0. Okay, anything more than 0, it's 1, 2, 3, 4, 5, then the difference becomes larger. Okay, so Professor Mashamba, Associate Professor at the University of Venda, was recently granted permission to take a 6-month sabbatical that will begin 20 months from today. Okay, so we are 20 months from today, so that's 20 periods. During the sabbatical, Professor Mashamba will need 30,000 Rand at the beginning of each month for living expenses in that month. At the beginning of each month. Okay, so now you're seeing, okay, I'm dealing with an annuity. Okay, so I'm dealing with an annuity at the beginning of the month. Okay, so if you work with tables and say, okay, I need to refer to the last 2 tables. Okay, or if you have your financial calculators, I need to set my calculator to that. Okay, but I must keep that in mind. Okay, 20 periods. His financial planner estimates that he'll earn an annual rate of 12% over the next year on any money he saves. Okay, so he's 12% in the next year, so it means he earns 1% per month, and the annual rate of return will remain at 12% during the start of his sabbatical period. At the end of each month during the year before the sabbatical, Professor Mashamba should save approximately how much? Okay, at the end of each month during the year, before a sabbatical, you should save approximately how much? Okay, so if you should save at the end of each month, that is a payment. Okay, he can earn 1% until the time that he can go on the sabbatical. Okay, and he's got 20 months to save until then. Okay, so how much is it that he needs to save? So let's go to number 5. The answer is B. You required, the first calculation that you do is you're required to pay out 30,000 Rand over 6 months. Okay, so if you want to, because 6 months sabbatical, you want to get an amount of 186,420. 186,420, you will be able to give you 30,000 Rand at the beginning of each period. Okay, that's the first thing that you need to do. You need to first decide how much money you need to cover. Now, as you can see, there is for table 3B. Okay, there's 1%, and then if you look at the 6 months, sorry, you can see there's so that's 6.214. So what you do is you say I need 30,000 Rand at the end of each month, at the beginning of each month, times the 6.214. That gives us 186,420. Okay, so that's how much money you need at the beginning of the sabbatical, 20 months from now. Okay, but you still need to save for that money. Okay, so how will you save for it? So you're going to save, and for the next 20 months, you will save 8,466 there, 8,466 Rand at the end of each month. Okay, don't confuse it with the other one where you want to withdraw the money at the beginning, because that's further in the future. This one, you use table 2B, which is the one at the end of the month. It's not an annuity due, it's an ordinary annuity, because you're saving at the end of the month. So you still get your 1%, you get 20 periods. Okay, you can see there's a 22.239. Sorry. And you divide that amount by 8466. Okay, so let's go to part B. Okay, Phumlani has recently seen a small house around Toronto area close to the University of Venda that she would like to buy. She thinks that it will be perfect for a new business renting out rooms to students around Univen. Okay, and the house costs 500,000 Rand. Phumlani would like to borrow this money from her parents and repay them 500,000 Rand in 10 years' time. Phumlani parents burst into laughter when she suggests this deal. Explain why Phumlani parents believe that this is not a good way for them to invest the pension. Okay. The problem is, if they give the money to her and she returns it a few years later, it'll be worth less for them. Okay, it's not a good investment for them. It'll be more a case of being nice to her. Okay, money depreciates over time. Inflation currently exists in most companies, in most economies in the world, and because there's a sustained increase in the general price level of goods and services over time. The result of this is that the purchasing power of 1 Rand does not remain the same. Phumlani's parents will therefore be able to buy fewer goods and services with the 500,000 Rand in 10 years' time, as this amount of money has lost value over time. It's also possible that Phumlani may be unable to repay her parents if the business does not go well. Her parents are therefore taking a risk if they lend her the money, and they will want to be compensated for this risk. Finally, Phumlani's parents need to continue to make more money when they're retired, as their pension continues to lose value over time while goods and services become more expensive. And to create wealth, they'll have to invest the capital in assets and products that provide them with a return on their investments, such as dividends, interest, and rental. And this loss in monetary value over time is called the time value of money. Okay. Name any 3 elements that affect the time value of money. Indicate the common symbols used for each element and briefly explain these elements. Okay, this is fairly straightforward. We've got present, future, we've got the time period, and we've got the interest rate. These are ones that you guys are dealing with frequently for time value of money. Okay, so these are the variables, and you should know it. Payments is PMT, future value, and so on. Okay, maximum 3 marks. Okay, then which would you rather receive? The proceeds from a 2-year investment, paying 5% simple interest per year, or one from paying 5% per year compound interest? Motivate your choice briefly. Okay, in this case, we need to work out what the present value is. If you compare 2 scenarios, always work out present value. It's as simple as that, because you want to know what is the value of money today. It doesn't matter what it is in the future, because it could have different future points. You want to know what it is worth today. Okay, so simple interest, we get the same interest each year. Okay, in this case, it is 5,000 for 2 years. So for the first year, the factor is 0.952, and for the second year is 0.907. As it goes further in the tables, the present value becomes less. Okay, so it's 9295. And for compound interest, in year 1, you'll receive 100,000 Rand times 5%, which is 5,000. So that's still the same. But year 2, it's now 105 times 5%, which is 5250. Okay, so 3 marks each, or 3 marks total. And that's 1.5 each. Okay, then the last question, why do companies need a financial manager? What does a financial manager do? Okay, a financial management deals with how the firm may increase its value over the long term while increasing its financial performance over the short term, ensuring its cash flows is sound and maintaining its solvency. Okay, financial management has to keep the cost of financing as low as possible and generate rates of return greater than the cost of capital, thus generating value. Okay, then financial performance requires that revenue must exceed expenses. This is not profitability. That's if you look at your statement of comprehensive income or your income statement, and you want to know how much profit you're making. And financial performance may be improved by limiting expenses to the essential and enabling marketing efforts to generate the best possible sales revenue. And financial management has to determine what assets are required by the business and evaluate this basis based on capital budgeting techniques and how to finance it at the lowest cost price possible. And an understanding of the balance sheet or the statement of financial position is vital for any manager. A firm also has to determine whether it is operating at a profit. Should the firm not generate enough profit and cash flow, it will not be able to pay its bills. There must be a cash budget. Managing the firm's cash inflows and outflows requires a cash budget, and that the cash budget is monitored from time to time in order to avoid any cash flow problems. Okay, and then there's financial ratios as well, which we're dealing with in Unit 3, and to assess the profitability, liquidity, and solvency of the firm. All right, so that is it for test 1. Are there any questions on this? Okay, just a heads up, please listen carefully. Financial ratios will be asked in the exam. Okay, it will come. So please be prepared. Even though I did not ask any of those in the test, it will come in the exam. Is that noted?
Yes, sir. Yes, sir.
Okay, very good. Okay, and the main thing with the financial ratios is please explain to me what you see. It's not so difficult to calculate stuff, but it's, you know, to show me the understanding of what you're doing, that is no different story. So please, based on the assignments I've seen some good ones, but I've also seen some ones that are not so good. So please take note of that. Okay, so I think we finish with test 1. Okay, then the one that you guys enjoyed so much is test 2. Okay, so this one is cost of capital. You guys don't seem to like this cost of capital so much, but we have to do it. So let's go through this one and see what we could have answered this. Okay, so this is a long scenario, but let's read through it and see what they're telling us. Okay, so we've got question 1 is 15 marks. While the basic rules of football have not changed for more than 100 years, the way spectators consume the match experience in a modern football stadium has changed significantly in recent years and will continue to change even faster in the next decade. Stadiums can be a key revenue generator for football clubs. Valuable assets on a club's performance, valuable assets in the club's balance sheet, and play a central role in achieving financial stable long-term success. Okay, so they need them. They need them to make money. They draw people, maybe not in COVID times, but and this is how they these are money spinners for them. Okay, but they're highly capital expensive. They're very expensive, and even a full small facility of 15 to 20,000 seats can cost in the hundreds of millions to build. So the Technical College of Venda is considering building a football and an athletic stadium to encourage the youth to be active and live a healthy lifestyle. Okay, so there's some cost analysis for the development and maintenance of the stadium. The design cost to the value of 25 million rand are expected to be incurred in August 2021. And design costs relates mostly to professional fees paid to architects and engineers contracted to develop the plans for the stadium. It is estimated that the process of tender administration and construction development will cost approximately 23.8 million rand per month. These fees will be incurred at the end of each month from the 1st of August to 33rd of August 2021. Okay, so for this one, I gave you guys a lot of extra information, and you would have noted that a lot of them was not used. Okay, so I took out, I wanted to give you guys capital investment questions with net present value and so forth, but I took it out, but I left the information in here. Okay, so some of you may have got a little bit confused and say, yeah, where do we use this information? It never comes. Okay, but I left it in there just as a twist. So if there wasn't some information that's used, that is correct. Some information was actually irrelevant for this one. Okay, what we're going to be looking at is the following one. The number of ordinary shares that was issued to finance this deal. Okay, so there's 2 million ordinary shares. Okay, then the book value of debt is 7%. Convertible debt is 290 million rand. Market value of a bank loan, market price of ordinary shares of today, market value of convertible debt, measure of systematic risk in relation to the market, that is beta, it's 1.2, and the yield on a government bond with a maturity date of 200 December 2025 is 5.5%, and earnings yield percentage from market portfolio of shares 16%, and 28% rate of taxation. So the Technical College of Venda expects the share price to rise in the future at an average nominal rate of 6% per year. Okay, so where do you see this kind of growth? If you do the cost of capital, you can look at the dividend growth model. You can see, okay, all right, that rings a bell. I can use that 6% there. Okay, and then the convertible debt can be redeemed at par in 6 years' time, or converted on that date into 1.5 shares per every 100 rand bond. It's expected that overall the stadium will yield a return in excess of 15% on invested capital. Okay, then there's a long story here. I'm not going to go through all this now. Let's go to the questions. Okay, so calculate the cost of equity using the capital asset pricing model. Okay, so what is the asset capital pricing model? Okay, so you can see here are some formulas that I've given you. This is the capital asset pricing model. So it is the risk-free, the cost of equity is risk-free rate plus beta plus times the difference between the required rate of return and the risk-free rate of return. Okay, so this information is all given to you. So let's just go to, you can see, okay, this might be a little bit small. Sorry for that. Okay, so the risk-free rate of return is 5.5%. Okay, so where do we get this? Let's go up. So we go find the 5.5%. So you can see the yield on a 204 Rand government bond with a maturity date. There's 5.5%. A government bond is risk-free. Yeah, so that's where you get it. So that's why I have to understand what is a risk-free rate. So that is actually very straightforward. Then beta is a 1.2 I was referring to. The 16% is the earnings yield percentage for a market portfolio of shares. There's your 16%. Okay, that's a required rate of return. And then, which means if you calculate it, it comes to 18.1%. So it's the 5.5 plus 1.2 times the 16 less the 5.5%. And that gives you 18.1%. Hey, that's all you had to do there. Calculate the cost of debt for the bank loan. Okay, so for the bank loan, you must remember, so they're giving you the 9%. Let's just go up here. Market value of 9% bank loan. It's 9%. So with a bank loan, with debt, you're able to deduct taxation because you need to work on the after cost, the after tax cost of debt. Okay, so it's 9% times 0.72 because you've got 28% tax rate. So you can see there's 9% on 0.72, and that gives you 6.48%. Okay, then the next one. So as you can see, it's a long story, but it's not really that difficult. It's just to get the required information from this long story that is given there at the top. Okay. Determine the value of ordinary shares in 6 years' time. Based on this value, conclude as to whether or not bondholders will convert their bonds into equity. Determine the value of ordinary shares in 6 years' time. Okay, so let's go down here. Okay, so the first thing that we need to do is, because we're talking about the convertible debt, okay, we need to say, I just want to go to the 55, confuse you guys here. Oops. Okay, so the market price of an ordinary share as of today is 55 Rand. Okay, that is after dividends is 55 Rand. So that is a present value. Okay, there's no payment. Then, just give me a second. The share price will rise at 6% per annum. So that is a interest rate of 6% per annum. Okay, it is 1 period per year. The future value will therefore be 78.02, and we're looking at 6 at 6 periods. Okay, so the number of shares per bond is 1.5. So the conversion of the shares, if you take the 78.02 times 1.5, gives you 117. So based on this, it is likely that the convertible bonds will be converted into shares in 6 years' time, as the par value of this bond in 6 years' time will be more than 100 Rand. Okay, so that is the comparison that you make. If you look at the cost of the convertible debt, it is 100 Rand. Okay. So that's what this question wanted you to do. They wanted you to compare to the par and say, okay, what would your decision be based on that? Okay, assuming that the bondholders will convert the convertible debt into equity, calculate the yield on the convertible bond. Okay, so we're now assuming that it's going to happen. Then we say, okay, the present value of the bond is 107.11. That is the market value. Let's go to this, go find the 107.11. You see, the market value of convertible debt is 107.11. The future value is 117 because you're converting it into, that's what's going to happen. This 117 was calculated here. It's 6, and then the payment is 5.04 because you're paying, but you can also, it is also after tax as well. Okay, so it's 7% times the 72%, so it's 5.04. So it means it is 6.03%. That is I. Okay, calculate the weighted average cost of capital for the Technical College of Vienna using market values. Okay, so as you can see at the top, you've been given market values here. Market value of bank loan, there's 169. Market value of ordinary shares of today is 55, but we also know that there's 2 million. And then the market value of convertible debt is 107.11. Okay, so if that is 100, it means if this is related to 100, we can work out what the total market value is here. So if we go down now, so for equity, we know it's 2 million, market is 55, gives us 110, bank loan is 169, and for convertible debt, as I said, you know what it is at 100, so you can calculate it at 107.11. You total all these. Okay, so the market rate for equity is 18.1% because we calculated it here with the CAPM, that gives us 18.1%. Bank loans is 6.48%. There's the cost of the bank loan in B. And then we've got the convertible debt is 6.03%. That's the yield of the bond. So then you can do your weighting and you can get your weighted average cost of capital in a normal way. Okay. Okay, that is that, and for E. And in your own words, distinguish between money and capital markets with examples. This question you also got in test 1, so I'm not going to continue, not going to repeat that. In your own words, discuss risk and identify between different categories of risks with examples. I just want to see. I don't know if I've actually got this one on the. I think I need to just add it. Okay, I'll need to add it for this one. I'll add it to the memorandum. Okay, but in essence, we can talk about systematic risk. We can talk about non-systematic risk. We can talk about risks that are within the organization that you can manage, and then we can also talk about the risks that is political, economic, social, environmental, and so forth. But I will add that as well to the memorandum. I see it's not here. Identify and outline any potentially unethical behavior and any contraventions of laws and regulations with the technical college or any of the shareholders of the directors. So I just want to go down here. Yeah, I also didn't add this one as well. Okay, so no fringe benefits on employee perks should include remuneration and pay as you earn. There's a failure to pay over VAT, that is a contravention of the VAT Act, and Mr. is holding shares in an offshore trust, possible breach of SRB regulation and non-disclosure from a tax perspective. Okay, for this one, it's kind of like something you just had to read through. If you go to the top here, I just want to say, Ms. Dr. Mbura states that the existing shareholder should not be required to contribute any capital to fund any development opportunities. Okay, her shareholding in a technical college of Venda is held through an offshore trust in which she is a major beneficiary, and she would be adverse to remitting any capital from offshore to finance a transaction of this nature. Okay. And then they're talking about the VAT here. The Technical College of Venda incurred penalties and interest 65,000 Rand in respect of a late payment of value-added tax. And employees are not charged for the services, nor is any amount of their remuneration allocated for these perks. That is another one. So those last three basically refer to where there could be in contravention of any laws and regulations. It's a little bit of a sideline question, so I won't be too harsh on you guys when I mark it, but it's just for you to actually just to read through the information that's given. That's basically what it is, to see that, have you read through it? Have you identified what is it that could go wrong here? Okay. Are there any questions on this? Did you like this paper? Okay. All right, so this is now number 2. That is done. Okay, so let's close number 2 and let's go to number 3. I'm busy marking paper number 3 now. And then I'll continue with the other 2. So this one was basically time value for money, and it was cost of capital. That's essentially what it was. So as you can see, there's all the formulas. Okay. All right, so there's the time value of money. There's a long story that they're giving you. It's a listed company, the mining operations, and so on. That should start receiving a salary of 25. Okay, so I'm not going to go through that. So let's just go to the question here. Calculate the total remuneration that Sibasa will be saving per month per employee based on the demand of the trade unions, assuming no work, no pay. Okay, some of you got this one right. Some of you didn't. Okay, so the total salary is at 12,500 plus a medical aid for 500 plus a RAF contribution that gives you 133,350. Some of you forgot the RAF contribution. Okay, so that's 1 mark. If you got it right, I gave you 1 mark. If you didn't, I gave you none. So it's either right or wrong. And then part B asked you to calculate the present value of all amounts that Tsibasa will have to put away at the end of the industrial action as of 1 February 2021 per employee. Okay, so the first thing that you need to do is remember they're giving you an effective rate of 5%. So you need to work backwards. Okay, so their money market account offers investors at an effective rate of 5% per annum on all deposits regardless of the amount for the first year of investment. Okay, so basically you have to start with the 5% and work out what the nominal rate is. Okay, normally in the exam, I will not give you guys something that is not rounded, especially for students that do not have financial calculators. But in this case, because it was an online test, you would have been able to have access to all sorts of things. And I did give you guys as an additional challenge. I did make test 2 and 3 a little bit more difficult than I would ordinarily make it for the exam, purely because it was online. Okay, so it was to offset the benefit that you have of being of doing it as a take home. Right, so that gives us 4.89%. So you had to use the 4.89% as an interest rate and not the 5%. Most of you used the 5%, which is not correct. Okay. So that was a cool 8 marks. You can see 2 marks for that and 6 marks for principle here. If you got this wrong, I would have given you like 6 out of 8 if you got that one. Or put it that way, if you got this one right, you would have got 2, and then you would have got maybe 4 here. Well, 4 here in this side. Okay, so I would have given you 6 out of 8 for using the wrong one for 5%. Okay, so instead of 8 out of 8. And then calculate the total opportunity cost of the 18 million rand per month at the end of the industrial action. Okay, just give me a second, guys. Just give me. Okay, all right, apologies. Okay, so calculate the total opportunity cost of the 18 million rand per month at the end of the industrial action period. Okay, so let's just go to. Okay, so what we need to do is, because it's going to be 12 months, it's going to be 12 periods. The opportunity cost in terms of percentage is 6%. And then it is 12 periods per year. Okay, so it's 3 months. It is 6% opportunity cost. So the future value would be 54,270. Okay. So if we go up here. So there's a nominal annual rate of 6%. Okay, and then we basically have to use that together with the 18 million rand at the end of each month as a payment, and therefore we can calculate what the total opportunity cost is. Okay, part D, let's go down to part D. What is the value of Luvani's accumulated RAF lump sum to when she retires? Okay, so let's just go to Luvani. Okay, so it is in this section here. Luvani Raptuma is a new employee which commenced work in the same date industrial assets action started. She also banks with Capitec Bank. She turned 28 on 1st of January 2021. She intends to work until she retires at 65 years of age. Okay, so she wants to find out how the industrial action is going to affect her as well as Subasa. She's not familiar with any financial management concepts. She'll ask you to help with certain calculations, that she should answer your questions. Okay, Subasa will commence deposit on the first day of the strike action. The strike is expected to last 3 months. Okay, so Levani will not participate in the strike action and therefore be paid his salary on the last monthly basis during the strike action. Okay, so let's just see if there's any more information. Okay, so the nominal rate is 7.2%. Okay, so there are 2 periods per year. So it gives us an effective rate of 7.33%. And then for 12, it gives us an effective nominal rate of 7.09%. Okay, and then we use the 7.09% because we always work with a nominal rate. 12 periods per annum is 350 per month. Okay, it's 443 periods. So you're looking at 65 years of age. There's 28 times 12 gives you 444. And there's 1. Present value is none. You're starting with 0. In other words, then you would build to 746,097.29. So that's 10 marks. So you actually have to work backwards in terms of this. And then there's 1 for presentation. I think so far I've given everybody 1 for presentation. You guys try to be neat at least. Okay, so that's in terms of this one. The second one you did quite a bit better. This is the cost of capital. It is commonly accepted that the crucial factor in the financial decision is cost of capital. There's for Nzilele Limited, there's some information given. Okay, explain what is meant by weighted average cost of capital for a particular company, and further explain why it's important to calculate the correct weighted average cost of capital. Okay, so I'm going to close this one. Let's go here and then say weighted average cost of capital is over return that the entity must generate on existing assets. So this is how you finance it for ordinary shares, preference shares, and debts. You determine the cost of capital for each component, and then it must be calculated with care. Then calculate the cost of capital for Nzilele Limited using the following information: a dividend growth model, and then the capital assets pricing model. Okay, so the dividend one, this is the KE over DO plus 1 plus growth over the value of the share plus growth. You can see that all the information is there, and then the capital asset pricing module is there. You guys generally got this correct, so you did well there. There's no issues. I think this was fairly straightforward. Then for part B, this is now independent, so all 3 of these would have been independent. PNG Limited is irredeemable loan capital outstanding, at which pays an annual rate of 10%. The market value of the loan is 88 per 100 Rand nominal value, and the tax rate is 28%. Okay, so the cost of D, so KD is always the interest. It's after tax cost of debt over the market value, not the book value, is 88, and that gives us 8.18% or 8.2. And then for cost of preference shares, which is irredeemable as well. In this case, there's no after-tax effect, so you can take the 12%, which is the dividend, is guaranteed. Over the market value is 90 cents. It gives us 13.33%. Okay, then the cost of debentures, because it's redeemable, it means there's a future value. It's redeemable at par, which is the 100 Rand here. The present value, which is the market value, is 110. And then the payment is always after tax. It's 8%, but it's a net of tax, so it's 8% times 0.72. It's 6 years, and the cost is 3.86. Okay, I had no problems here whatsoever. This is easy to mark. You guys are getting it right, correct, the majority of the time. So I think you did okay here. Okay, that is that. We've covered the assessments today. Hopefully it was useful for you guys. So are there any questions? Okay, if there are no more questions, then I'm going to stop this session.